Hello, everyone, and thank you for joining our user group session titled Fixed Assets Processes and Policies, Building Consistency and Control. Let me introduce Angela Bolton, our Senior Product Manager and Superwoman galore for everything Stage Fixed Assets. Angela, take it away.
Thank you. I hope I follow suit to what you just called me. Superwoman, she's my favorite.
You will.
Thank you, everybody, for joining us today on another user group session. I am excited to talk to you today about fixed asset processes and policies. So as we start thinking about policies and a fixed assets journey, in particular, holistically, we kind of think about how do things happen in the world? How do things happen in our software, in our process? And how does data happen? And where does data come in and out? And all these things. And what I want to really point out when we first get started is strong outcomes don't happen by accident. Meaning when we have success, it's not an accident. It's not like, oh, all of a sudden, here we are. No, there's more to it. So it starts with really clear policies that everyone can contribute to, can access, can reuse, modify, and go forward. It also is processes that are repeatable over and over again, that anyone that comes into the organization can pick up and start repeating the same process over and over so that everyone's on the same page. There has to be ownership, right? So we predefine the ownership of who owns the piece of the policy or process from the AP standpoint to the CIP or construction in progress standpoint to before the asset becomes an asset to tagging it to depreciating it, managing it, inventorying it, reporting on it, and all these different facades, right? And then with that comes effective internal controls. So again, it's not by accident, it's by all these things coming together in one puzzle, if you will, right? So when we start talking through this, I want to just picture, if you will, the journey of a fixed asset. There's many different spots along its journey that it has to go through in order to even just get into the system. And then once it's in the system to be reported all the way from what we call fixed assets cradle to grave. I'm sure most of you have heard that terminology. I use it quite often. It's the very first invoice for this asset that we're purchasing, and everything it touches along its journey all has its own place. With that being said, I put together this list and I think that I'm missing a few things, but then I'm like, but if I make it too big, no one will see it and read it. So I kept it at 13 steps that I see in a real world scenarios from doing this for almost 28 years now. When a fixed assets journey first starts, we talk about and think about when we get those asset invoices and we're putting it into the ERP and then we're reformatting that data. And then once we do that, if we're in CIP, then we split it into the project and manage it through CIP with all the transactions in and out, and then recording that against the budget. And then we have to check in with the project managers. And then once we do that, we have to determine, are we splitting these assets out into their components, into different separate assets, or are we splitting them into multi-assets or keeping it one? So there's a lot of stuff that goes on at that level. And then how are we getting those assets into our subledger? For tax purposes, are we keeping them in a spreadsheet? Are we putting them in a system that we own so we can be the stewards of our data? Are we sending it out to a CPA firm? All these different things. What is that process? And are we integrating this data? Where are we doing the manual work? Where are we doing these activities and adjustments once it's placed in service? And on and on and on in the circle. And it's quite a bit. So when we go around this circle, this is usually what a typical monthly process looks like from a holistic standpoint. So what happens here is that manual hours are super high. So when we go through this journey today, I want you to keep thinking, where along this journey am I really doing all this manual work? But where then can I automate this process? Can I tighten this process? And which tools can work best for this? And which people need to be part of the conversation? So then when we're looking at these manual processes, and we also want to think about how many hands are touching the process itself. How many people are involved? Are the right people involved? And when this is when error risk is elevated, is usually when multiple people are touching it, or the wrong people are touching it, or the right people are not involved. And this also leads to audit and compliance issues along the fixed asset journey. In addition to that, think of all the turnover that can, does, and could happen along this journey of the fixed asset and the process that you have. If policy enforcement is inconsistent, guess what? So is the data. So I kind of want to get a touch point. Where the fixed asset lifecycle does your organization experience the most friction or risk within your fixed asset journey?
Everyone get your final polls in there. We really appreciate it.
And we'll share these results too after the end when we share the slides as well, so everyone can kind of see where everyone's at. Okay, so let's dive in and take it to stage one, which is the planning and the approval. So this is before an asset ever even shows up in your system. Decisions are already having to be made about where does this process really start? What qualifies as an asset? What qualifies as capital versus expense? What's our threshold, perhaps, might be a question. Who actually approves this spend? Is there approval process in place? What does that process look like? Is it automated? Is it manual? What I see all the time is that someone buys something thinking it's capital, and then AP books it as expense. And it's not necessarily their fault, but this is what happens when there's not a policy in place or a process in place too. Sometimes, like, what are we actually typing from the invoice into the system that allows us to determine if it's capital or expense? If it's a vague description that's an invoice description, not necessarily an asset description, I see that a lot, then that's kind of where it could start, right? That's where it might start as a pain in the neck. So watch my language for a minute. On a pain in the neck on its journey all the way to the end. This is not a system issue. Keep that in mind. It's a policy clarity issue of how are we entering this data in from the very, very beginning. A system, just so we're all clear, is just a database. What we put in it is what we get out of it, right? So if your capitalization thresholds aren't very clear, or if your GL accounts don't also line up with your asset categories, I see that as well, then that's also where inconsistency can start. And once it starts upstream, it just compounds over the rest of its life. So some process questions. Is there a documented approval workflow that I can work with? And how are my GL accounts aligned with asset categories in the subledger for other reporting? Because the journey of a fixed asset doesn't just live internally, it also lives externally. What does that mean? It means that asset categories can be read by property tax reporting and assessments, auditors, outside CPA firms, other people internally that are looking at the data. They may not know what these GL accounts are. So always kind of living outside of your knowledge base, thinking outside the box. If I were in someone else's shoes, what do they need to look at? And whatever they're looking at, whatever I'm looking at, are they talking and are they aligned? So we're all speaking the same language regardless. So what happens here is that inconsistency, if it starts here at the very beginning, when we're data entering those invoice payments or credits or whatever, then what that means is that down the road, there's going to be a lot more rework, a lot more looking for things that we didn't have to spend our time on previously if we did it right the first time. So then we move to stage two, which is acquisition and initial recording of all these different assets. So now that the asset is purchased, it's real, it needs to be recorded. And, where is the process discipline at? Do we have it? And this is where it really matters, okay? So when we talk about, well, how does this data move from our ERP, AP, PO system into our fixed asset subledger? Who reviews it? Does it even go directly into our subledger? Maybe it stops at CIP. And how do you determine the place of service date? And who determines that? And how do we system check the service date with the asset in the field when it's actually ready to be on the subledger? Are multi-book rules applied? And are they applied consistently across all the different asset categories? I see this quite often too, when we don't have a proper policy in place, which gives us what I refer to as a depreciation matrix. A depreciation matrix is saying, if this is furniture and fixtures, then for internal book, it'll be straight line 10 years. But in tax, it might be, well, it usually is, maker's formula, the 200 declining balance, and now with bonus. So I get that extra. Now, if I don't know this and there's nothing to tell me because I'm in finance, how would I know? I'm just going to guess. And what happens when we guess is we have a lot of problems and a lot of data that we have to clean up at the end, either each quarter and no matter what at the year end. So these are some things that we really need to consider. Right? And then how many organizations this step still involves a manual exports, spreadsheet adjustments? How many times are you reformatting this data? Are you splitting it by company? How are you moving this data all around when you're actually trying to place it in service? What does that look like for you? And the more manual interpretation that's involved, then the more room there is for inconsistency. Meaning, if I'm a user and I don't have a policy in front of me or a process documentation, and it's up to me, well, maybe my onboarding was horrible. And maybe my training was training from a trainer who was trained from a trainer before me by 3 times. So what are we doing here? Maybe our interpretation for furniture and fixtures is 7 years for tax because everything's 7 years. Or maybe when I'm entering into a subledger system, it defaults to 7 years. So I'm assuming that's correct, but that's not necessarily for your particular policy. Right? So the key question you want to ask yourself is, are your depreciation rules embedded into your process or dependent on a person handling the file that month? Meaning up to their own interpretation. So without a policy embedded, the human interpretation fills the gap. And that leaves a lot of room for error and inconsistencies, which will leave a lot of room for nightmares when everyone's scurrying at month end, quarter end, year end. Okay. Stage 3 of the journey is construction in progress, or CIP. And not everyone has this. Some companies don't necessarily need to do this, but a lot do actually. So this is before the asset becomes an asset, right? CIP, to me, is one of the most understood areas in the entire life cycle of a fixed asset journey. And here is where policy definitely needs to be defined, and not just defined, but very clearly defined and stated and written out, okay? So what I always think about is like, well, what qualifies CIP? That's always the first question. And people are like, Angie, that's duh. I'm like, I know, but seriously, what qualifies a CIP? Not everybody has that, right? Like for restaurants, for example, qualified CIP would definitely be like buildings, leasehold improvements, a build out, a tear down, a rebrand of the assets, all those sort of things. And they don't necessarily need a whole project. They just need to be purchased, placed in service, and moved, right? So what really qualifies as CIP? Because different software, do SaaS software implementations require CIP, where just buying licenses of software doesn't? So you really have to define these so that people understand what they're placing in service and what they're not. And so this is where documentation is really required, because it sets the tone for how we're going to take care and manage this data on a go-forward basis. In practice, I often see CIP sitting too long or being moved inconsistently, and sometimes not reconciled regularly, especially if you have complex spreadsheets that are what I call quote unquote template that you're just reusing and reusing, and then the next person comes in, reuses it differently, and so forth. So that also breaks the consistency. And for CIP projects that might be years long, moving from a different spreadsheet to a different spreadsheet, you start to lose that information. You start to lose the integrity of it. And you also start to lose what the insights could be bringing you if it were automated all in one spot, or at least had a policy that wrapped it around in a nice bow. So if no one is owning or monitoring these CIP projects, they linger, and that affects depreciation's timing, reporting accuracy, and more so audit exposure, which nobody wants, So CIP really requires both the policy clarity and also the process accountability, because those that take care of CIP, if you're in that boat and your organization does a lot of CIP and you're very CIP heavy, it's not always the same person who is managing the fixed assets when they're in service. So that's just another person that you have to involve in this journey, right? And involve them in this documentation, in this process, and understand, what does that process look like to them? How is their data coming to them from accounting? How is that data being presented, offered, manipulated, manually adjusted, copy pasted into something else? And then once that happens in its place of service, what does that look like to them? And the one who's taking care of the fixed asset management part, what do they need from the CIP people in order to do their job? So the journey of a fixed asset really involves so many different people. Like if you've come to any of my sessions before, you know that I talk about the full life cycle of a fixed asset and how it involves so many different departments. Literally everyone touches fixed assets within the organization. And you have to think, well, what is my role? How do I want to get that data for my role? And can we all talk together and see how we can make that possible and put it in a policy and a process that fits all of us? So the common gap that I see in CIP is that it either sits too long or it moves inconsistency. And sometimes I've seen this, especially in high intensive CIP and high volume asset industries. Sometimes it never moves at all. When I've gone in and reconciled data for people before, I've noticed that the CIP was closed, like the project was closed. It stated that on their spreadsheet anyways. But when we went in to reconcile that against their assets, they actually never moved over. They were never placed in service, which is a huge, huge thing. And this was closed in a year. So these are things that you really need to consider and think of when you move through this journey and this building this process and these policies. I want to stop here and I want to take another poll because we're going to start talking about the inconsistencies of your data and your fixed asset records. And so I want to get a little pulse on what that means to you. So what most often causes inconsistencies in your fixed asset records? It's always good to see what everyone's thinking. And from a product development standpoint, it's also nice to see trends that we can look at our roadmap and see what we can tackle next for you. All right, let's move on to stage 4, which is depreciation and management. One of my favorites, actually. Well, actually, CIP is my favorite if we're going to be honest. So once the asset's in service, we tend to think that the hard part's over, but it's actually kind of just beginning in a sense. Once we have the assets in, we have to think of what kind of consistency do we want to show up within the assets once they're in service. So we've visited this, but it still is worth revisiting because now this is where the meat is. Our useful lives standard, are they standardized across our asset records? If you don't have a policy or you haven't revisited your policy, these are things that you can still go in and look at your current data and see what your current data looks like and start thinking about this step, this stage 4 of the journey. Now, before I even look at my policy or update it, on my current data, are my useful lives standardized? Do they jive with all the furniture and fixtures? Do they jive with all the machinery equipment? Do they jive with the building improvements? Have we broke them down? Are conventions applied consistently? Meaning like, was this a mid-quarter? Did it capture all the assets? Did I get all the assets in the mid-quarter applicability? What about bonus and those sort of things? And then also overrides, multi-book differences, are they clearly defined? And then the big one is, do your depreciation rules live in documentation or in someone's head? Again, going back to the interpretation of somebody else. I also want to talk about adjustments because I see this quite often too. If we don't have a clear defined path for late invoicing, because fixed assets, I always say, there's a reason why I've been doing this for so long because it's always intriguing to me. Someone always comes to me and says, I do it this way. And I was like, I've never heard of that before. Let's figure out how we can make that work. But what I see time and time again is that late invoicing, everyone has their own idea, especially when it's not documented. What does your late invoicing look like? I was at one company once and it was beautiful. They had a 90-day policy. If the late invoice came in after 90 days, then they had to go through an approval process to hold accountability and ownership of that. And I really liked that because then it made everyone slow down and look at their policy, their process in particular. Why did it take that long? And so it was a good checks and balance along their journey, which I really liked. I don't know if everyone wants to adopt something like that, but I thought it was pretty clever. Also, they put adjustments late invoicing still through the CIP, which is beautiful. So it still rolls up to the budget, but they can still see, is there a trend? Do I see a trend along this journey of this project? We keep getting these late invoices. Maybe now we can take that information, because knowledge is power, and we could go back to the vendors and back to the project manager. There's lots of things that you can unveil there. So other departments too, you have to think about the other departments. Not only should monthly depreciation be routine and repeatable, that doesn't require someone's interpretation every single time, especially if they're reviewing it, but other department depreciation controls too, like state or tax. Always looking at it from a huge holistic perspective, not just living in a vacuum, and just looking at, I'm finance, I'm just looking at my gap. Well, if you have the Sage fixed asset system, you know that it's one of the best for tax depreciation. So why would you use your investment to capture everything that you could? Be the steward of your data. You know your data best. I was just working with a client not too long ago, and we received their outsourced tax data. And when we started reconciling it back to their one-to-one record, it was impossible. So instead of trying to match what was impossible, we just recreated these books and ran them in the system and then compared the variance because it was so offbeat. It was crazy and it was sad. It was sad for me. But I always say, be the steward of your data. You see your process and your policies. You see everything coming through. You're touching the data. Everyone's touching the asset along its journey. You would know what is true and what is not. And so if you have a depreciation matrix in your policy, then it would be so easy for them to understand what tax depreciation rules, what state depreciation rules, keeping accurate records for treasury, maybe for FP&A, audit, SOX, or insurance adjusters and property tax reporting. If you have an automated system, why are you not? That's a question I always ask. Why are you not using it for all these other aspects of the fixed asset journey? Why are you only using it for GAAP? Let's say you have the tools, you invested, use it for what it's worth, and use it for the full journey of your fixed assets. So when you have all of these policies, then you have these processes that governs all these beautiful things, timely running. So a lot of times too, there's a timing involved, because not only does the fixed asset manager have to run the depreciation, enter all the assets, process all the adjustments, disposals, transfers if you have them, and tie back, but then you also have to give it back to the GL to reconcile. And that's not always usually the same person either, depending on your organization. So there's timing issues. And especially if you have multi-jurisdiction, multi-locations, there's timing issues there too to close. So let's speed this process up. When we have policies and processes, we're ensuring too that we're meeting those timings and those reviewings and having time to handle any exceptions that we come across. So if rules live in spreadsheets or in someone's head, clearly, for sure, we're going to have audit risk increases. We're going to have a lot of problems. I want to be clear that it's not just about audit. It's also a bottleneck. If we don't have something that's clear, it's a bottleneck, meaning someone else can't get their job done on time or right. And then it looks like it was them. And then people blame the system. It's not a system issue. It's a process policy issue. If it's not written, it's not clearly defined for someone to pick up and run with it, dirty data in is dirty data out. So stage 5, this is kind of a gray area that kind of starts creeping in a little bit, because different things happen throughout its lifetime, even though it's placed in service. So, we have repairs versus capital improvements. And how do we handle those on an ongoing basis within our asset subledger? We have component replacements or componentization and period. If we're taking a look at our data that exists today, where can we componentize out, split those assets out into their own assets? Which is super helpful when someone needs to either sell that asset, dispose of it, transfer it, do budgetary replacement projections and forecasting on it. We don't know what we don't know if it's all bulked together. So these are some other things. And then software versus SaaS, which I was kind of talking about earlier. These things definitely need a different policy guardrail, just so that we can make better judgment calls when these come to fruition. Same with fair market value, impairments. Maybe we're extending the life. Maybe we just did a big repair on a big piece of machinery equipment that also not only needed to have a life extension, but it needed to be broken out to find that repair, to replace that repair, to dispose that repair, and then add the new one in. And we're probably all laughing because we're like, oh yeah, I've seen that before. It's very common. So we need to wrap policy around that, so that when that occurs, we're not like, oh my God, what did we do last time? And how did that work? Who did we have to involve last time? If it's written down clearly, you will always know. So inconsistent treatment here doesn't just affect one asset. It affects trends. It affects forecasting. It affects audit defensibility, especially for property tax audits. And some people go to court over those things. If you have clear records because your policies and processes are perfect, well, at least close to perfect, then that would not be an issue and it wouldn't stress you out. It also standardizes everything, which is where everyone would love to be. I know it. If you say no, I know you're just joking. So inconsistent decisions here really distort your depreciation trends along the board. Just reiterating what we just said about reporting across all different aspects of the fixed asset journey. So stage 6, if you operate in multiple entities, then this stage gets even more complex, because now you have different movements, different routing happening, different documentation and reconciliation with intercompany transfers, movements between different things, and allocating costs across different subledgers, and lining all the books across all the different tax books and state, maybe ADS, maybe you're taking care of earnings and profits book, multi-state books, or even a budget book within here. And how are we going to take care of this gain or loss treatment? Are we going to defer it for a different period? Are we going to take it right away? What does that look like as far as what type of asset class it is, and those sort of things? So routing to the correct data set. If routing and ownership aren't clear, then you end up with assets in the wrong companies, which I've seen a lot. And then I've always seen is the books are totally misaligned, which means there's a different cost in one book than another book because the adjustments weren't booked right, or where does the data entry happen? Does it happen at the individual company level and then roll up to corporate? Or is it all at corporate? Maybe I gave them the wrong stuff because I didn't know what they needed because it wasn't written. So again, it's not a system issue. Can you see that now? It's a process definition issue. This is where these are so important. Stage 7 is asset transactions. So what are transactions? They're either retired assets, so you can bulk dispose, partial dispose, full dispose. Impairment triggers. We hear that a lot, especially these days. Impairments happen, and they're happening more frequently. And just so you know, on our roadmap, we do have it etched out, not for the next release, but we're seeing about what the timing looks like to put an impairment process in place. It's really important. It's been asked for a long time. And also, because of the current economic landscape that we're in, this seems to be a trend that's never going away. So, how are they recorded? Who takes care of those? Where do we get this study done, right? Who's even doing these impairment studies? Who do I reach out to? Where do I go? What do they need? What does it need to look like? What report do they need? If your data is messy because we missed stage 6, 5, 4, 3 and on, that's going to be messy and it's not going to be awesome for anybody to hand that data off for anybody to do an impairment study. So it all rolls up and downhill in a full cycle, doesn't it? So we wanted to define who defines these disposals. How are they recorded? Who approves them? What does the approval process look like, right? So one of the most common audit findings I see, obviously, is that assets are disposed operationally, but they're never removed from the books. And the other way around, quite frankly, I've seen it both sides. So we also need to not forget the physical inventory cycle of this too. That's a whole other policy. It's like a sub policy within the policy. A lot of times it's a sub of that because that in itself warrants its own policy. How often are we going to do this? Are we going to do little checks and balances? Are we going to do the full physical inventory at once? Is that every 2 years, 5 years, 3 years? What does that look like? Have we even ever done one? Last time we did one, what did that look like? Where did we fail? Where can we improve? All of these things also need to be wrapped up because they all matter. They all matter. They all hit something that's really important to our bottom line. Okay. If disposal identification isn't built around your operational flow, then assets linger and they linger and they linger. And that distorts reporting all over the place. So we talk about insurance. If something happens to us, natural disasters occur. With our weather these days, it's occurring more than not. If we were to replace all of our assets, do we know what ones we're replacing, which ones we use, which ones we don't use? And based off of that information, are we confident? And I mean 100%. Are we 100% confident that we will get back what we lost so we can reopen in a timely manner? Over all these years, I've seen quite a few companies who were the opposite. They never got a physical inventory done, or they were really late. It's been 20 years since they did one. And then their building caught on fire from the inside out. And then they didn't have accurate records. And then they didn't get back what they needed to reopen. So guess what? They closed. So these are super important things to think about, especially now. We just started a new year for most of us. We're moving through it. What does that look like for the rest of the year? How can we plan this out so that next year, any hurdles we ran over this year, we're jumping over those hurdles, right? So again, just to reiterate, the common issue that we see is that assets remain on the books long after the disposal has occurred. And that's throwing off your property taxes too, and your budgeting and forecasting for any other CIP. Again, if you're CIP heavy, that also intercepts and affects your CIP forecasting for budgets for projects you want to do next year. So where inconsistency typically appears, where I see it happening a lot, is the threshold applications, meaning what systems are we using? What capitalization thresholds do we have? What do those look like? What do we do with those that don't? Do we still record them in the subledger, but as expense to don't depreciate? No matter what, they should be in CIP if you're holding CIP. What does that timing look like? Different depreciation overrides. Like, how are we running this depreciation? What does our matrix look like? Does everybody have access to that? Who, what, why, where, when? CIP monitoring occurs and delays on that. CIP is really, to me, outside of how we enter it into AP or PO, CIP is the most critical step if you're a CIP heavy company. In fact, if you do your CIP right, you should be using CIP to funnel everything through, like all new assets. And you're just using the stage depreciation to just do that, depreciate across all books, okay? So unrecorded disposals are huge. And then disposals that are recorded but they're still using it on the shop floor. Like I see that a lot. Oops, we made a mistake. Let's put it back into service. And then you see this big lump and chunk of catch-up depreciation. And then the biggest one is spreadsheet-driven adjustments, which I like to call manual data manipulation. Okay, that's the big one. That's where I see the most inconsistent, especially if you have turnover and it's handed down from user to user to user to user, right? With no documentation. So then we talk about, well, what do we do? How do we build this consistency across the life cycle? How do we do this without over-engineering everything from scratch? And what I like to say is you don't add more rules, you clarify the ones you already have, okay? You don't have to define ownership at each stage all at once. It would be good if you did, that would be brilliant, but start small. Just look at holistically who enters the data into our ERP, who takes care of the subledger, who does the CIP, are they the same people? Can we join them together? Open communication. And you can standardize review checkpoints along the way. What does this look like? Does this match here? And I don't mean you have to reconcile in 10 different ways, but the checkpoints of, is this working? Is this still moving super smoothly? Is there something that we can redefine, something that we can automate in this process? You know, so that's one thing that when I consult with people, I always ask, great, holistically, I already know what your process probably looks like, but where are you doing manual work? We'll look at the manual work. Those are where the risks lie, right? So every time someone's doing something manually with all this data, especially if you have high volume, that's usually the trigger point for me. We start there and then we look outward to say, okay, well, who does that touch when you're doing this manual? How long does that take you? Then how long does it take that person to do that? Their job? Is that manual? Is it manual and system heavy? Okay. What does that look like? Are they getting the right data? And what does that look like from an hours perspective? And then we funnel back down to an error perspective, and we funnel back down to inconsistencies perspective. And then where are we at risk? So then we want to make sure that our ERP, our fixed asset systems, and our GL systems are aligned. And we periodically step back and ask again, does our policy still reflect how we operate? Is there consistency across the life cycle? And does it create control? Control is what creates confidence, right? So especially at close and audit time or year-end time, when we're handing it off for tax prep, it's the confidence. So when I talk about any journey, whether it's personal journey, work journey, data journey, at the end, whatever journey you're on, always leads to confidence. And when we're confident, then we know we have confidence in our data, we have confidence in our systems, in our reporting, in anybody who comes and questions our work or questions our data, we're confident. So some of these things I want you to walk away with your team, and do get your team together. Again, fixed assets touches every aspect of a business. Every aspect. You're not the only one entering the data or taking care of the data, managing the data, working with the data, understanding the data, moving the data, reporting the data, right? So it really, it's across all different departments, like finance for sure, but tax, audit, financial planning and analysis, treasury, maybe third-party service firms, facilities that are involved, project management involved, and more. So where in the life cycle do you experience the most friction? And then, is your biggest risk at acquisition CIP, or is it the disposal process, or is it standardization is also what I should put here? And are your depreciation rules documented, or is it tribal knowledge, meaning in someone else's brain? So these are some things that really impact you. And these are the things that you can start with today to just ask your team and then see what transpires, right? You'll probably have all these different things coming in. Make sure you're taking notes, come with paper, come with a whiteboard. I love whiteboards. I have like 4 at my home. And then just see what happens. Again, even if you already have a policy and process, but you haven't revisited it, because I know I know out there, fixed assets gets like the last review of processes and policies. They're usually looking at that from a higher perspective, from like the core accounting. But when you dive into the fixed assets, because as you see, the journey is very long and very vast, a lot of people don't look at the fixed asset piece. And if they do, it's very minimal. But now is a good time to, again, ask these questions to your team. with your policy that you even have right now and see where you can put more control. So the last poll question, if you could improve one area, just one area of your fixed asset process this year in 2026, what would create the most impact for you? Thank you everybody again for participating. And my final words are consistency matters. It reduces your audit adjustments, it improves reporting accuracy, standardizes things, supports governance, creates long-term efficiency, turnover resilience. You want to be, at the end of the day, what I'd love for everybody is, if someone were to retire and someone comes in, you want to be able to hand them a policy and procedure and say, here you go, let me show you a few tips and tricks, but you'll be able to just follow along and pick right back up where someone left off, right? That is the ultimate goal here, because strong fixed asset outcomes don't happen by accident. Remember that, they are built. So we'll go into questions.
Looks like we did have a few questions, although I do think one of them might have been answered, but what tends to cause some of the biggest delays for CIP?
The biggest delays that I see are all the invoicing, right? So people will, if they get a huge influx of transactions and they can't get it out of their ERP system efficiently. So not necessarily like a speed thing, but it's more of like, am I getting all this data accurate? And when they take it out of APPO, they're looking at all of the descriptive information and there isn't much there. And so that's where I see the biggest bottleneck before it goes to CIP, because so you need to know what those transactions are and how to identify what project they go to, and AKA line item or asset they will be someday. So that's where I see the biggest bottleneck is through that process. But once it's in CIP and it's fully identified, then it's easy to then follow that with more transactions going forward, and then once it's in service, just move it over, right? That's kind of easy. But yeah, the bottleneck that I see always is in between, where those transactions need to be identified and deciphered more so. And that's also where I see a policy deficiency in the process of the policy is, how are you entering that information? So CIP can easily identify, pick that up, understand what it is, so I can move in a orderly fashion, if you will.
Ooh, so are there any SAGE training classes on useful lives or depreciation methods? I know one of the biggest issues is determining useful lives and methods.
That's a good question. So we don't have a training on that, usually because we ask you to work with your CPA on which is best for you. There are typical ones. If you're using Sage Fixed Assets, down in the corner when you have it open in your company, there's an IRS table which helps you determine what the best standards are for different classes of assets. I think I had a user group session last year that was similar, but if that's something that you guys all need, let me know and I can put something together, maybe another user group session that just touches base on that. Please,
Oh,
please,
looks
please.
like
Okay.
I love it.
Will do. Noted.
Another one, it looks like on impairment policy, we have one as a company. When you say on the roadmap, does that mean there will be a process integrated with Sage Fixed Assets?
Yes, that's correct. It'll be a transaction. So it'll be under, where you do disposals and transfers, it'll be in that tab.
Let's see. This one was a little bit earlier on. I don't know if this is more a response or a question. It looks like we've had issues of getting told when assets need disposals from department heads.
Yeah, that sounds like a comment, but I see that I do see that a lot. So that's where you really want to get what I talked about, getting everyone involved. There's so many times where literally like VP finance and VP tax were literally right next door with their doors closed, and they call me to have me ask them. And I said, I know that they're there because they just texted me. So why don't you just go next door? So just a reminder that we don't live in a vacuum. Open it up, open your doors, and open the conversation, and you'll be astonished what you might find, or not astonished, either way. But just involve everybody, just so that they know too that this is what it looks like. This is what our process looks like right now, and how, as a team, 5 heads are better than one. Community, I'm really moving myself into a lot of community lately, because I find you just learn so much more, and I think that reigns true in an organization too.
Looks like we got another one, late invoice policy. Looks like it might be something interesting to a little bit further into.
Yeah, late invoicing. So, stuff happens. I'll say stuff happens in fixed assets. So a lot of times you'll have a progress payment that came in like 30 days, sometimes a year late. And then you'll also maybe have credits that come in, rebates or whatever, and then sales tax or shipping or anything. There's some really weird stuff that happens sometimes. So with late invoicing, what you have to determine though is that, and really look at, I want to hit base for some reason, I feel like I have to say this, is that if it's a late invoice that was over a year or moved between fiscal year ends, then you definitely want to have a policy around that, because that really can impact, depending on how often that happens, what the cost is it material, immaterial, it gets different tax treatment when we do that. And so from a finance perspective, we think, oh, we'll just add it as an adjustment to the asset, no big deal, and keep moving forward. But from a tax perspective, it can either be we're taking mid-quarter this year or we're not, if we did it in the year it was supposed to versus when we got it. So again, this is where it's nice to have a policy and a process for those, because it does affect other departments and it does affect different reporting, like tax filing. So these are things that you want to touch base on. Those were great questions. If anything comes up later, just feel free to email me at angela.bolton@sage.com, and then I can answer them, or at least point you in the right direction. So thank you again, everyone. It's my pleasure to be here today and share some knowledge.
Thank you, everyone. Have a wonderful rest of your day.